Successful trading can be risk on each traded, win rate, risk to reward, and how many traders you take, that's it. Understanding these four numbers will make the trading process much smoother and will help you to reach your goal of the trading for the living. All the components and numbers work together. Here's how. First component, capital and the risk per trade. To be successful, you must control the risk to in each positions you take. So risk of the maximum of the percentage of your account on the each trade. For example, if you have $10,000 account, risk up to $100 to the each trade. Also, place a stop loss order to make sure you don't lose more than 1% of your account. Once you know your entry price and the stop loss level, you simply have to determine your position size. How many shares lost on the contract you take in the stocks market, Forex, or the whatever market you are trading. 1% may not seem like a lot to risk, but as you will find out late in the video, our winning traders should always be bigger than your losing traders. While you only risk 1%, you strive to make 1.5% to 3% on your winners, risking $100 to make 150 to 300, for examples. Only risking 1% also means that even if you hit the losing sticks of the 5 to 10 trades, you haven't lost much capital. Risk more than 1% though, and losing sticks can declaim your account. Second component, risk reward. The risk rewards is how much you make on the winning trades relative to how much you lose on the losing trades. If you are always risking 1% of your capital, then your risk to reward should at a minimum be 1 to 1.5. That means you are making 1.5% on your winning trades and losing 1% on your losing trades. To accomplish this, you must place the profit target that has greater distance from your entry point compared to your stop loss order. For example, if you buy a stocks at $10 and place the stop loss at $9, and the risk would represent approximately 1% of your account capital based on your position size, then your target you would need to be placed near 11 and $5. If you lose, you lose $1 per share, but if you win, you make $1.5. Now, risk reward is interlinked with the win rate. And that's the third component, win rate. The win rate is how many traders you win expressed as the percentage. If you make 100 traders in the demo account and win 55 of them, your win rate is 55%. Win rate is connected with the risk reward. You should strive to keep your win rate near 50% or above. That's way if the risk reward on each trade is 1 to 1.5 or above, you will be a profitable trader. Assuming you are able to maintain the 1.5 risk to reward over 100 trades, you are adding 1.5% to your account and winners, and losing 1% of the account capital on the loss. If you win 50% of your trades, your account will be in a good shape. Let's do the math. 50 winning traders, 1.5% equals 75% losing traders. 50 to 1%, you get 25%. You increase your account capability by 25% over those 100 trades. If you win for 40% of your trades, then you don't make any money. 40 winning traders to 1.5%, 60 losing traders to 1% equals 0%. Sees how winning rate to risk reward are linked. If you only win for 40% to 50% of your traders, try to bump it up to 50% or more by making small changes to your strategy. Alternatively, you could try to reduce risk slightly or increase your rewards slightly to improve your risk rewards. Slight adjust could push it this break-even or losing strategy toward being a profitable one. Find a component number of the traders from the number of the discussion. Your goal is to win more than 50% of your traders and make 1.5% or more relative to the 1% you're risking. If you can do that, the more traders you take that still allow you to maintain those statistics, the better. If you make one trade per day, it's about 22 trades per month. If you win 50%, 1.5 risk reward, you maintain 11 to 1.5%. That will be like 11 to 1% equals 5.5% increase. If you make 2 trades per day, you win 22 trades and lose 22 trades, but your percentage return increasing to 11% or the months. Of course, don't get caught up in these numbers and don't take traders for this shake of taking traders. This will not increase your profit. All traders' stake must be part of the strategy that allows you to win 50% or more, with the 1.5% or the greater risk reward. If you take traders with the poor probability or winning or where your reward doesn't compensate for the risk, this will drag down your statistics, leading lower return or the loss. If any of the statistics fail, it will hurt your result. It's a result thin line between the profitable trading and the losing. Over 100 trades with winning 50 means the nice income, while the winning only 40 means you break even or lose money when accounting or commissions. A slight drop in the win rate or the risk reward can move you from the profitable to the unprofitable territory. Risking too much to each trade can also decline your account quickly if you hit losing sticks. Winning 50% of your trades doesn't mean that you will always follow the pattern of the win-lose. Wins and lose are distributed randomly. Some days you may lose all the trades you take, while other days you may win them all. There is no specific numbers of the traders you should or need to take each day. However, over many days, it shows average out to at least 1 or 2 trades per day if you want to reach. However, many days it showed average at least 1 or 2 trades per day. If you want to reach the 5 to 10% per month return mark, the only way to do the strategy can produce this number is to test it in a demo account. Take hundreds of the trades as the strategy produced the result discussed when. Then you have some assurance but no guarantees that the strategy can produce those figures in the future. Small adjustments may be required over time to keep the strategy aligned with the target numbers. If the strategy produces those numbers, then only trade that strategy. Also very important, don't trade any strategy that is untested, because untested strategy typically drag down your win rate and the risk reward ratio. The main problem is that while you can see the math works over 10 or 100 trades while you are in the trade, it's very hard to remember the big picture. Most new traders can stand losing, so they exit winning trades with the tiny profit messing up their risk reward. or they hold a losing trade, not wanted to accept in the lose, and end up losing much more than the 1% of the single trade. This also measuring the risk reward and could potentially declaim the account. New traders also need to remember that the wins and the losses are not eventually distributions. You may win or lose several trades in a row. Winning sticks doesn't mean that you're a phenomenal trader and you can lose your strategy. Likewise, losing sticks doesn't mean that you are the bad trader. The only thing that matters is how many traders you win and lose out of the 100, which is about how many traders you will want to take each month for the 10% gain. Win more than 50 with the reward to risk 1.5 to 1, and you will be the very profitable trader, even if you had a few days in a row when they lost every single trade you made. Of course, this is the ideal scenario. Some months will bring 5%, other will be break-even months with the profits what's over. And if you win less than 40%, you will record red months. But the long term, as the long as you stick with this simple plan, you will grow your account slow and steady. Also very important to make the 100 of the day trades in the demo account using the same strategy to see the win rate, risk reward, and the number of the trades per day it produced. Only utilize real capital once you have the hundreds of the trades worth of the data and the strategy is showing profit over those numbers. If you learned something new and found value, leave us a like to show your support, and don't forget to subscribe, to hit the bell icon to stay notified, in touch with the new uploads. Until next time.